The average American with a credit card balance is carrying $6,500 in debt right now. At the current average APR of just under 21%, that balance alone costs roughly $1,365 a year in interest before a single hidden fee is added on top. And that is the part most people are completely missing. Because on top of the interest, there are late fees averaging nearly $34 per hit, cash advance fees of up to 5% with zero grace period, foreign transaction fees of up to 3% that can trigger on purchases you made from your couch in Dallas, balance transfer fees between 3 and 5% that quietly eat into the very savings you were trying to create, and penalty APRs as high as 29.99% that can kick in after just one missed payment and stay there for months. When you add it all up, the average American who is not paying close attention is handing their credit card company hundreds of dollars a year in completely avoidable fees. I'm breaking down every single one of them, where they come from, how they get triggered, and exactly how to stop paying them starting right now. I'm Michael Harris, and welcome back to Dollar Sense USA, where we talk about real money, real numbers, and decisions you can make today to keep more of what you earn. Here is the honest picture of where America stands with credit cards heading into 2026. Total U.S. credit card debt has just hit $1.27 trillion, an all-time record. The average cardholder is carrying a balance of $6,500. The average APR on credit cards right now sits at just under 21%, and for new card offers, that number climbs as high as 23 to 27% depending on your credit profile. 47% of all credit card holders in the country are carrying a balance from one month to the next, meaning they are paying interest every single billing cycle. And 61% of those people have been in credit card debt for at least a year, up from 53% just a year ago. So the interest problem is real. But here is what today's video is specifically about. A massive chunk of what Americans are losing to their credit cards every year is not coming from the interest rate on their balance. It is coming from a set of fees that are technically disclosed in the fine print of your cardholder agreement, but in practice are understood by very few people until after they have already been charged. These fees are not accidents. They are engineered revenue streams. And the credit card industry collects billions of dollars from them every single year from people who either did not know the fee existed, did not realize their behavior would trigger it, or simply never thought to push back and ask for it to be removed. By the end of this video, that is going to change for you. Help this reach more people. Tap like, and let's get into it. Let's start with the one fee that most Americans have at least heard of, but dramatically underestimate: the late payment fee. On the surface, this one feels simple. You miss a payment, you get charged a fee. The average late fee in the United States right now is approximately $33 to $34 per occurrence, according to Wallet Hub. And for the roughly 25% of Americans who admit to missing a credit card payment in the past year, that number adds up fast. Two late payments over the course of a year, and you have already handed your card company $65 to $70 in fees alone, before any additional interest is factored in. But here's what's shocking, and this is the part that catches people off guard. A late payment does not just cost you the late fee. In most cases, a payment that is 30 days or more overdue triggers a penalty APR on your account. The penalty APR is a higher interest rate that replaces your standard purchase rate, and it can be as high as 29.99% on many major cards. That is not a typo. Nearly 30% annual interest on every dollar you are carrying. And the penalty APR does not just apply to future purchases. On many cards, it retroactively applies to your entire existing balance. So that one late payment did not just cost you $34. Depending on your balance, it may have effectively increased your annual interest cost by hundreds of dollars until you demonstrate 6 consecutive on-time payments and the card issuer agrees to restore your standard rate. The fix here is straightforward but requires intention. Set up autopay for at least the minimum payment due on every card you carry. Not because minimum payments are a good long-term strategy. They are not, and we will get to that. But because autopay is the one guaranteed way to ensure a missed payment never happens due to a busy week, a forgotten due date, or a paycheck that hit one day late. If you are already carrying a balance and have been hit with a late fee, call your card issuer. If you have a history of on-time payments and this is your first or second offense, many major issuers will waive the fee as a one-time courtesy. That phone call takes 5 minutes and can save you $30 to $40 immediately. Now let me explain the cash advance fee, because this one is operating almost completely in the shadows for a huge portion of American cardholders, and the cost structure is genuinely alarming when you lay it out clearly. A cash advance is any transaction where you use your credit card to access cash directly. That includes using your card at an ATM, transferring money from your credit card to your checking account online, or using the convenience checks your card issuer sends you in the mail. Here is the fee structure most people do not fully understand. Cash advances typically carry a fee of around 3 to 5% of the amount you withdraw, charged up front the moment the transaction processes. So if you pull $500 from an ATM using your credit card, you immediately owe $25 in cash advance fees on top of the withdrawal itself. But here's where it gets even more expensive. Unlike regular purchases, cash advances do not have a grace period. On standard purchases, if you pay your statement balance in full by the due date, you owe zero interest. That is the grace period working in your favor. Cash advances start accruing interest from the exact second the transaction is completed. And the interest rate applied to cash advances is typically 5 to 10 percentage points higher than your standard purchase APR. On a card with a 21% purchase rate, your cash advance rate might be 26 or 27%, and that interest is running from day one. It does not wait for your statement to close. It does not wait for a due date. It starts immediately and compounds daily until the balance is paid. The math on even a modest cash advance is brutal. Pull $500 as a cash advance. Pay the 3% upfront fee, that is $15 gone immediately. Then carry that balance for 2 months at a 27% cash advance APR, and you have paid close to another $23 in interest on top of the fee. A $500 withdrawal effectively costs you over $538 to repay, and that is a best-case scenario where you clear it in 60 days. If that balance lingers longer, which it often does because minimum payments barely touch the principal, the cost compounds further. The rule is simple. Never use your credit card to access cash unless you are facing a genuine financial emergency with zero other options. Keep a small cash emergency fund, even a couple $100 in a savings account, specifically to avoid this situation. And now here's where it gets interesting, because the next hidden fee is one that is catching tens of millions of Americans completely off guard, including people who are sitting in their living rooms in Chicago or Houston and have not been anywhere near an international airport this year. Foreign transaction fees are charges of typically 2 to 3% that credit cards apply to any purchase processed through a non-American payment system. Most people understand this applies when they travel overseas. What most people do not realize is that it also applies to online purchases made from international merchants, even if the price was listed in US dollars, even if you never saw anything that indicated the merchant was based outside the country, and even if you completed the entire transaction from your kitchen table in Phoenix. The reason this happens is that the fee is triggered by where the merchant's payment processor is located, not where you are. If you buy something from a global website and their payment system happens to route through a European processor, your card may automatically charge you a foreign transaction fee without any visible indication on the checkout page. At 3%, this fee might look small on a $20 order. But for someone who regularly shops at international online retailers, clothing, electronics, specialty goods, this fee can accumulate to hundreds of dollars over a full year entirely without their awareness. The solution is to check whether your card charges a foreign transaction fee before shopping internationally, either in person or online. Many travel-focused credit cards have eliminated foreign transaction fees entirely. Issuers including Capital One do not charge this fee on any of their cards. Discover is another issuer that generally does not apply it. If you travel frequently or regularly shop from international websites, switching to a card with no foreign transaction fee is one of the highest impact, lowest effort financial changes you can make. Before we go any further, smash that like button right now if this video is already showing you things your card company was hoping you would never figure out. And hit subscribe to Dollar Sense USA because this is exactly the kind of content we bring you every single week. Real numbers, real fees, real strategies. Drop a comment below and tell me this. Which of these fees have you personally been hit with? Was it the late fee, the cash advance trap, or the foreign transaction charge on an online order? I want to know. Your answers help shape the content we create for you. Now let me explain the balance transfer fee, because this one has a particular kind of sting to it, because it often hits people who are actively trying to do the right thing with their finances. Balance transfers are one of the most powerful debt management tools available to American consumers right now. The concept is straightforward. You move a high-interest credit card balance onto a new card that offers a 0% introductory APR period, often lasting anywhere from 12 to 21 months, giving yourself a window to pay down principal without interest accumulating on top of it. For someone carrying $6,000 at 21% interest, a successful balance transfer to a 0% card for 18 months could save over $1,000 in interest charges. That is a genuinely valuable strategy, and it works. But here's the kicker, and this is what catches people off guard. Virtually every balance transfer offer comes with a balance transfer fee of 3 to 5% of the amount you move. On a $6,000 transfer at 3%, that is $180 charged to your new card the moment the transfer processes. At 5%, that is $300. This fee does not eliminate the value of a balance transfer. For most people with large balances and high interest rates, the math still works out strongly in their favor. But it is a cost that has to be factored into the calculation up front, and far too many people execute a balance transfer without accounting for it, then wonder why their new 0% card does not look quite as clean as expected. The second risk with balance transfers is equally important. That 0% introductory rate is fragile. On most cards, a single missed payment during the promotional period is enough for the issuer to terminate the 0% rate immediately and apply either the standard purchase APR or the penalty APR, sometimes as high as 29.99%, to the entire transferred balance. So the very debt you moved to escape high interest can suddenly be sitting at nearly 30% if you miss one payment. The fix is to set up autopay for at least the minimum payment the moment the balance transfer is complete, and to make a written schedule showing exactly how much you need to pay each month to clear the balance before the promotional period expires. There is also the annual fee conversation that deserves real attention, because this is one area where Americans are losing money in two opposite directions simultaneously. Some people are paying annual fees on cards that provide genuinely excellent value and do not fully realize how much benefit they are entitled to claim. Others are paying annual fees on cards they essentially never use, getting almost nothing in return and continuing to renew year after year purely out of inertia. Annual fees on credit cards range from $0 on no-frills cards all the way to $500, $600, or even $700 annually on premium travel and rewards cards. The fee itself is not inherently a bad thing. A card charging $95 a year that gives you $300 in travel credits, lounge access, and meaningful cashback is mathematically a profitable product to carry. The problem is that 65% of Americans who carry rewards cards with annual fees are not fully redeeming the benefits those fees are supposed to deliver. They are paying $95 or $100 annually for a card whose full value they are only capturing $40 or $50 of. That gap is pure profit for the card issuer. The discipline here is to audit your annual fee cards every 12 months, ideally 30 days before your renewal date. List out every benefit your card offers: travel credits, dining credits, lounge passes, cashback categories, purchase protections. Then honestly assess how much of that value you actually used in the past year. If the benefits you claimed exceed the annual fee you paid, the card is worth keeping. If the benefits you claimed fall below the fee, cancel or downgrade to a no annual fee version before the renewal charges. Many issuers will also offer retention bonuses or fee waivers if you call and indicate you are considering canceling. A 5-minute phone call to ask for a fee waiver is often successful for loyal customers with a clean payment history. And here's what most people never even think to ask about: the return payment fee. This one is nearly invisible because it only strikes under a specific circumstance, and yet it is one of the more frustrating fees because it punishes a person twice for a single mistake. A return payment fee occurs when you submit a payment to your credit card but the payment fails because your checking account did not have sufficient funds to cover it, because you provided incorrect banking information, or because the account you tried to pay from was already closed. The fee for a return payment typically ranges from $25 to $41, depending on the issuer. And here is the part that makes it particularly costly. A return payment does not just trigger a fee. It also means your payment was never actually received, which means your account may now be heading toward a late payment status, with all the associated penalties that come with it. So a return payment can cascade into a late fee, plus a penalty APR, plus the return payment fee itself, all from one transaction where the money simply was not in the account at the moment the payment was processed. The safest approach is to maintain a small buffer in your checking account, even $100 to $200, that you do not touch, purely to ensure your credit card autopay never bounces. It also pays to schedule your credit card payment for the day after your paycheck typically lands, rather than the day before. That one-day shift eliminates the scenario where your payment processes before your direct deposit clears. Now let me pull back and talk about the bigger picture, because all of these individual fees, when you look at them together, form a pattern that the credit card industry has spent decades perfecting. The fees are real. They are disclosed. They are legal. But they are designed to be triggered by the exact behaviors that financially stretched Americans are most likely to exhibit: a late payment when cash is tight, a cash advance in an emergency, an online purchase from an international retailer, a balance transfer executed without fully reading the terms. The system is not built for your benefit. It is built to generate revenue from the moments when you are least able to notice or push back. The statistic that puts all of this in the starkest light is this. If you carry the average American balance of $6,500 and make only the minimum payment every month, it will take you over 7 years to pay off that balance. And you will have paid roughly $3,600 in interest alone, not counting a single hidden fee along the way. That is more than half your original balance paid purely in the cost of carrying the debt. And every late fee, every cash advance, every avoidable annual fee, every foreign transaction charge accelerates that spiral further. The path out is practical and specific. Pay more than the minimum every single month. Even an extra $20 or $30 reduces your timeline and total interest costs significantly because you are shrinking the principal faster. Set up AutoPay to protect your payment history from the fees and rate consequences of a single missed payment. Audit your cards annually to make sure every fee you are paying is justified by real, claimed value. Stop using your credit card as an ATM. There is almost never a situation where a cash advance is the best available option. And if you are a frequent traveler or online shopper, take 30 minutes to find a card that does not charge foreign transaction fees and use that card exclusively for those purchases. These are not revolutionary strategies. They are straightforward, accessible steps that any American in New York, in Los Angeles, in Houston, in Atlanta, in Chicago can implement starting today. The credit card companies are counting on your inertia. They are counting on you skimming your statement rather than studying it. They are counting on you not calling to ask for the late fee waiver. They are counting on you carrying that balance for 7 years instead of 4. The moment you stop doing what they are counting on, you start winning. Let me quickly recap what we covered today. The average American is carrying $6,500 in credit card debt at an average APR of just under 21%, costing roughly $1,365 a year in interest alone, before a single fee is calculated. On top of that interest, late payment fees averaging nearly $34 can also trigger a penalty APR of up to 29.99%, a rate that can apply to your entire balance and stay in place for months after a single missed payment. Cash advance fees of 3 to 5% charged up front, combined with interest that starts accruing from the moment of the transaction at rates 5 to 10 points above your standard APR, make pulling cash from your credit card one of the most expensive financial moves available. Foreign transaction fees of 2 to 3% can silently trigger on online purchases from international merchants without any obvious warning, adding up to hundreds of dollars a year for regular online shoppers who never thought to check. Balance transfer fees of 3 to 5% are a real cost that must be factored into your debt management math before executing a transfer. And annual fees on cards whose benefits you are not fully using are simply money handed to the issuer with nothing in return. The action plan is clear. Set up AutoPay immediately to protect your payment history and avoid both late fees and penalty APRs. Stop using credit cards to access cash. Check whether your card charges foreign transaction fees and switch to one that does not if you shop internationally. Factor the balance transfer fee into your math before moving any debt. Audit your annual fee cards before every renewal date. And call your card issuer to request fee waivers. A polite phone call works far more often than most people realize. Click that like button if this video helped you understand exactly where your money has been going. Subscribe to Dollar Sense USA so you never miss a video that puts real dollars back in your pocket. Drop a comment and tell me, which of these fees have you personally been charged? And did you know you could push back on them? Share this video with someone in your life who is carrying credit card debt and feeling like they can never get ahead. Because sometimes the problem is not the balance, it is the fees stacking on top of it that nobody explained. Next video, we are going deep on the minimum payment trap, the exact math on how credit card companies design minimum payments to keep you in debt for years, and the specific payoff strategies that cut your timeline in half. You do not want to miss that one. Until then, stay sharp, stay informed, and protect your money.